you guys know about the crypto markets in general and whether or not they are going to see the much vaunted and expected price boom in September of 2024. To which the answer is, if it doesn't say so on the VEPs, it's not likely to happen. If it does say so on the VEPs, it's likely to happen. What I mean by say so, I mean if the volatility, entropy, probability, and statistics indicate that price go up in September, yeah, then it probably will. But we're still a month away from there. And to make predictions at that length of time, while we certainly can do that, we can certainly know, for example, what the direction of the reverse mean will be, right, etc. We can tell when assets are in mean reversion, even on high time frames and all that, right? The fact is, intraday, movements, right? The low time frames affect the higher time frames. Right? Yes, the higher time frames have more gravitas. They have more, quote unquote weight. Even though we're talking about pixels on the screen, it has no physical weight, but it has more significance. Call it that. Right? Mathematically, it has more significance because it takes more time to build up higher time frames. But that's the only thing about them, right? They are changed on the lowest, every moment, right? So the lowest time frame is where you see the changes happening in real time, and then they roll out across the higher time frames, right? So why do I mention that? I mention that because you'll notice there's a lot of people on the internet saying, "Oh, crypto's going to go to the moon in September." Listen, it may very well do quite nicely starting in September. It frankly may do very well quite nicely this month. Although for now, the projections are looking pretty down for Bitcoin and a lot of other things at the moment, right? It's still looking pretty much to the downside, at least for, some probable movements that have very high probabilities to hit certain targets to the downside. How far does that go? Well, it can go all kinds of places, right? There's many targets to the downside on different time frames. Right? I can show you targets that are down in like the 35K level. It's possible. Does it mean it's going to? Not necessarily. Does it mean it can? Yeah, it definitely can. Right? It doesn't mean it's going to, but it definitely can. Right? It's a probability. It's not 0, it's not 100. Right? It's everywhere in between 0 and 100. So, don't be essentially conned by these, people selling you FOMO or FUD, either way, right? FOMO is when they try to get you to jump on board before it goes high. They tell you it's going to buy now before it's too late. And FUD is the exact opposite when they try to get you to sell out, before it's too late, right? They go, you better sell now or you're going to lose everything. Listen, if you're a serious trader, that stuff is just background noise, and something you should definitely be ignoring, right? The problem is that too many people get suckered in, either because they're bored, right, or they're just looking at information across different channels, and they just leave something playing in the background. They may not even notice it, and it affects them, subconsciously. They keep hearing repetitious lies and misinformation without recognizing that they're obviously lies and misinformation, right? Like when somebody's showing you Fibonacci retracement of price action, honestly, they have no, and they're telling you that that's a way to trade. They genuinely have no way to trade. They don't know how. Okay, now they might tell you they do. They might show you certain winning trades, but ask them how many trades out of the last 1,000 or 10,000 trades they were actually profitable using that. Right? Ask them to show you that P&L and the list of trades that they use just that, right? Or that and whatever other strategy component they use in the strategy. The fact is, people are using Voodoo TA. That's why they're getting hammered, right? Because Voodoo TA is designed to fail, right? The vast majority of the time. It's not designed to succeed, right? If it was, guess what? Then most retail traders would be successful, right? Be a cakewalk. If we could all just use Fibonacci retracements or EMAs or SMAs or other silly things, we would all have had access to these tools from the very beginning, and we'd all be zillionaires. But that's not how markets work, right? Markets move liquidity from them that don't know how to operate to them that do, right? So what does that mean? Well, that means if you're trading, for example, volatile assets like crypto, for example, or anything, but specifically volatile assets, then you need to trade relatively fast moves, right? Now, does that mean you have to trade the 1 minute? No, but should you swing trade crypto? It's probably a really bad idea. Yeah, it generally does not work out. Why? Well, because the probabilities are against you. The likelihood is that the asset, which inevitably will mean revert, will do that to you when you're not looking, which is the reason number one not to try to swing trade volatile assets. And that goes, by the way, for any asset class, especially if you're using leverage. Right? If you're using leverage, you're creating your own involuntary volatility, or you're creating additional risk. It's not really volatility, but you're creating additional risk in the sense of, but it's kind of volatility because you're amping up the power of every increment of a move. Right? So if it goes to the in the way you're trading, great, you're greatly increasing your profits by however much volatility is. But if it goes against you, you're greatly increasing your losses by however much it moves against you. And guess what it's going to do if you're trading poorly, using poor information, and you're trading on a crypto exchange where they can trade against you, and they do all the time? Well, you're probably going to lose because they're not in the business of giving money to people who take leverage, right? The leverage is just a way for the exchange to get your money from you to them faster. That's all it is. It's not any other thing. It's not, some nice way for them to be equitable and give everybody a fair shot at life, right? That's not what exchanges are in the business of doing. They're there to make money. And the more they take from you, the more they make from you. So the more leverage you use, the more likely you are to lose your money. Because statistics, right? Statistics indicate that most people who use leverage in crypto, A, have no idea what they're doing. B, even those that do know what they're doing in terms of how to run the trade don't necessarily know what they're doing in terms of the information that they need to know to make the trade properly. And C, even if they know the information properly, they're probably not taking the right actions. In other words, they're not getting in and out fast enough. They're not, hitting their targets and taking profits right away. And if they're in a losing position, they're not limiting their losses and getting out as quickly as possible, right? And most likely, they're emotionally attached to their trades. So don't do that. Join the Alpha Trading Discord. It's free. alphatradinghq.com/discord. Come get your free indicators, your free charts, and your free education, and participate in the greatest little trading community on the planet. All right, again, alphatradinghq.com/discord. You're welcome. See you there. Happy trading.